Hey, welcome back everyone. This is Uncle Frank, and I am not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. From the Hill Sunday, Trump says Americans will receive $2,000 each from tariff push. And that means me and Al from Boston will have to start doing lives again. President Trump said Sunday that each American will receive at least $2,000 from tariff revenue collected by the administration. Quote, a dividend of $2,000 a person, not including high-income people, will be paid to everyone, the president said on his Truth Social platform. He added that those against the tariffs are fools. Such a proposal would likely need to be passed by Congress. Quote, my legislation would allow hardworking Americans to benefit from the wealth that Trump's tariffs are returning to this country, according to Howley. Treasury Secretary Scott Bessent told CNBC in August that the administration's priority is paying down the $38 trillion national debt using the tariff revenue. Through the first 3 quarters of this year, the Treasury Department collected $195 billion from tariff duties, according to its September statement. And it would appear the old man went to cash. Billionaire Berkshire Hathaway CEO Warren Buffett is pouring billions upon billions of dollars into U.S. debt. New SEC filings show Berkshire Hathaway surged its short-term Treasury bill holdings by $61.76 billion in the third quarter of 2025, reaching $305 billion by September 30th. Buffett's moves emphasize the legendary investor's focus on safety and liquidity in uncertain markets, prioritizing low-risk U.S. debt amid volatility. Sunday morning, Goldman Sachs said we're not in an AI bubble, and its young multimillionaire clientele are all in on AI energy investments and healthcare innovations. I don't know what I was worried about. Goldman Sachs says there's not going to be a bubble. Vanguard reveals what could be coming for U.S. stocks, and it's raising alarm bells for retirees. According to Vanguard, the U.S. stock market is expected to deliver an annualized return of between 3.3 to 5.3% over the next 10 years. That is considerably lower than the previous 10 years. Since 2015, the S&P 500 has delivered an annualized return of 15.26%. In other words, Vanguard's analysts believe future performance won't be nearly as impressive as investors have experienced in recent years. From this past week, NVIDIA and Oracle to build the Department of Energy's largest AI supercomputer named Solstice. At GTC Washington, NVIDIA announced a major collaboration with Oracle to build the U.S. Department of Energy's largest AI supercomputer designed to power the next decade of American scientific innovation. The new Solstice system will feature a record-breaking 100,000 NVIDIA Blackwell GPUs, delivering unprecedented AI performance to accelerate research across energy, defense, and science. Michael Burry, are you sure you want to short NVIDIA? From Insider Monkey this weekend, Jim Cramer on NVIDIA. I can't blame anyone for selling, and you know what that means. NVIDIA is going to be the world's first $6 trillion company. The company became the world's first $5 trillion company in late October of 2025, reaching the milestone amid a boom in artificial intelligence. Are we going to get this bubble or not? That's the big question, and when? Quote, this time really is different. Ray Dalio warns Fed is stimulating the economy into a bubble. The U.S. Fed Reserve's decision to ease monetary policy is inflating an economic bubble that could drive up the prices of hard assets, but also marks the final phase of a 75-year economic cycle, according to former hedge fund manager Ray Dalio. Typically, the Fed Reserve eases interest rates when economic activity is stagnating or declining Asset prices are falling, unemployment is high, and credit dries up, as seen during the Great Depression of the 1930s or the 2008 financial crisis. However, as Dalio wrote in an article posted to X this week, the Fed is now easing monetary policy at a time of low unemployment, economic growth, and rising asset markets. Dalio wrote, which is typical of late-stage economies saddled with too much debt. In this case, I disagree. I think everyone is underestimating how bad the job market really is and how much worse it's going to get. But also from this weekend, tech workers are in deep, deep trouble. For years, any American kid eyeing a stable, future-proof job was told to learn to code. Now in 2025, anyone who followed that advice faces a painful reckoning. A decade of booming computer science enrollments have created a massive pileup of graduates entering an abysmal job market. A new report from the analyst firm Challenger Gray & Christmas, which tracks layoffs across various industries, found that the U.S. tech industry had the highest number of layoffs in October of any sector, with a whopping 33,281 tech workers out of a job. That's an awfully high number for 1 month, and it looks even worse in context. Just a month earlier, the number of tech industry layoffs was only 5,639. Tech companies are planning to lay off 141,000 plus jobs this year so far, per the report, up from 120,000 over the same period in 2024. And it likely may not look much better in the near future. Quote, it's possible with rate cuts and a strong showing in November, companies may make a late season push for employees. The report reads, but at this point, we do not expect a strong seasonal hiring environment for 2025. This is a situation I've been monitoring closely. This is a problem, and it's not going away. Gen Z is under financial pressure. In the third quarter, the Fed Reserve Bank of New York found that student loan debt is up $47 billion from a year ago, while credit card debt is up $67 billion and mortgage debt is up $478 billion. Other factors include slower wage growth and higher rent. Per JP Morgan Chase, workers ages 25 to 29 have seen the sharpest slowdown in income gains, while B of A found that homeownership rates for those under 35 years old is significantly lower than for those who are older. For those renting, rent inflation was 3.5%, according to the latest CPI report published last month. Pressures on America's youngest consumers include unemployment, which is disproportionately affecting younger Americans. In August, unemployment among Americans ages 20 to 24 stood at 9.2%, up from 7.9% just a year ago, while the overall rate was 4.3%. Plus, student loan collections returned in April for the first time since March 2020, and the second highest amount of student loan debt is held by the 25 to 34-year-old demographic. But on topic, Trump's sweeping student loan repayment changes are a big step closer to reaching borrowers. The Department of Education concluded its negotiations on Trump's student loan repayment overhaul. The rule condenses existing income-driven repayment plans and institutes new caps on graduate and professional borrowing. The changes will begin taking effect in July of 2026. You young people got to hang on until then. So what is Kathy long going into the end of the year? Here's the top 10 holdings of the ARK Innovation ETF as of November 7th. She's long Tesla, Roku, Coinbase, CRISPR, Shopify, Tempest AI, Advanced Micro Devices, Robinhood, Palantir, and Roblox. And now I hear she's loading up on Pinterest. Does anyone use that anymore? You need to buy more Archer Aviation, Cupcake. Now, this is something every gold bug is watching. Gold price today, Friday, November 7th. Gold moves above 4,000 after stock prices dip. I've got 4,009.80, but did you know this? Historically, the months when gold performs the best on average are January, September, and December. These periods are driven by a combination of cultural demand and investor behavior. Let's start with December. Shows strong seasonality with an average return of 1.5%, largely due to the continuation of the Indian wedding season and general holiday shopping in Western countries. January, often the strongest single month, with an average return of around 1.6 to 1.9%. This is commonly referred to as the January effect, where investors reallocate their portfolios after the new year and invest year-end bonuses. Chinese New Year demand also often falls in late January or February, contributing to the uptick. They still love to kick AMC when it's down. Is there any hope left for this former meme stock? Down 35% in 2025, meme mania has long since passed for AMC Entertainment, which has fallen over 99% from its 2021 highs and more than 35% this year alone. Despite being far cheaper today, the stock is richly priced when using fundamentals-based valuation metrics. With cheaper alternatives out there for investors bullish on a recovery in the movie theater industry, don't give your hopes up on AMC Entertainment. I'm going to give you something to watch out for. And there it is. That's Adam Aron's legacy. This is the monthly chart since the day he began running AMC into the ground with debt, a reverse stock split, the ape. This is all on him and his CFO. You can't blame Wall Street or Kenny anymore. This was a great 100-year-old company with a degenerate thief at the helm. He had the most devoted shareholder base in stock market history, in my opinion, and he pissed it away while paying himself and his management team top salaries by title throughout the entire saga. But I find this chart much more fascinating. Now that's the insider trading record for AMC over the past 8 years, with literally dozens of highly paid senior executives and figure another 9-10 board members. Not one of them has ever bought even a single share of AMC in over 8 years. Over that same time, they sold over $1 billion in stock on the open market. That one sole buy was on Tara Capital, and they're out of business now. I don't think I've ever seen anything like this in my life. It's shocking, but as repulsive as this chart is to me, it may also hold a clue to when AMC could turn around in the future. At this point, this was one of the worst experiences of my life, mainly because I felt my research was correct. The original bet was Netflix is all we need. AMC will go bankrupt. But it didn't, but the stock fell. The bet then became we'll never be profitable again. We proved that false, but the stock fell again. Then the bet became we'll never do better than pre-pandemic numbers. Well, we did that once, and the stock fell further. There's plenty of blame to go around, but I don't blame the predatory hedge funds or the regulators that did nothing to stop them. I blame Adam Aron and Sean Goodman specifically because they were paid to protect me and my investment and violated that fiduciary duty with every bad idea and every dirty policy decision that directly benefited the very same people most shareholders blame for it all. In retrospect, I find it ironic that this disgusting table may be the only help left for AMC and its shareholders. I should warn you, AMC still has the worst and most corrupt senior management team in the entire stock universe. And I mean that. I have no faith or trust in them whatsoever. But now I believe that if and when you see insiders begin buying this stock again, if ever, that could be the signal that they're done bleeding us out for every drop of blood we have. And they see a future in their own stock price. They won't be doing it for us, the people that made them wealthy. No, it will just be a signal that they see an opportunity to make even more money for themselves. Now, all this talk about insider buying and selling made me want to do an experiment. On your screen is Utz Brands, UTZ, stock symbol UTZ on the NYSE. They're down over 43% over the past year and over 34% year to date. The company, UTZ, makes snacks. They're based in Pennsylvania and have multiple manufacturing facilities located across the U.S. to serve their customer base. They've also been around for over 100 years and manufacture a diverse portfolio of savory snacks through popular brands including On the Border, Chips and Dips, Golden Flake, Zapp's, Boulder Canyon, Hawaiian Brand, and Tortillas, among others. Their revenue over the past 4 years looks pretty solid to me. And I've got to admit, their earnings per share history over the past 16 quarters seems solid. I've seen much worse, am I right? Now, according to Investor Place Digest, it's been a terrible, horrible, no good, very bad year for consumer goods stocks. Shares of Kraft Heinz have fallen 22% since January, while Hain Celestial Group has plummeted 80%. Even Procter & Gamble, a symbol of corporate boringness, is down 8% this year. That's left many of these ultra-stable companies trading at incredible discounts, right as markets are fretting about sky-high tech valuations. But UTZ's profit outlook has remained steady this year, thanks to its focus on prices and cost efficiencies. Profits are expected to rise 5% this year and 15% the next. Yet over the past year, shares of this snack food giant have declined 34% in lockstep with other consumer goods stocks. The stock now trades for just 13 times forward earnings, roughly half of its long-term average. A post-earnings sell-off triggered a flurry of insider buying. On your screen is the past couple of months. Unlike Adam Aron, their CEO bought 7,200 shares at $10.58. Their CFO bought 477 shares at $10.47. Their chief legal officer bought 965 shares at $10.35. And a director bought 31,750 shares at $10.58. That's no Philip later, right? This type of executive cluster buying could indicate that the entire management team believes their shares are undervalued. Third quarter earnings met estimates, so to them, there was no good reason for its 12% post-earnings sell-off. So what I see is the insiders putting up nearly $1.5 million of their own dollars over the past couple of months with not one seller in sight. I could buy the stock lower than they did right now. So just for fun, I'm taking a small position in this one just to see if the food executives are right, not investment advice or advisor. Now, in my research, I found this interesting. First Eagle Investment increased its stake in Utz Brands by 13.9% in Q2, buying 78,400 shares to hold 640,500 shares of the company, valued at roughly $8 million, while institutional investors collectively own 95.97% of the stock. There doesn't seem to be many retail investors here at all. And it's the same broke-ass investors and Gen Z people that will be buying this stuff to live on in the months ahead. You know, snacks and ramen noodles. And it turns out even Jim Cramer thinks UTZ is too low here. Utz Brands is one of the stocks Jim Cramer was focused on recently. A caller asked what they should do with their position in the stock, and Cramer stated, Utz is really hard to own. I remember when they had it, of course. Mad Men, my daughter's in this business. It's one tough business, potato chips with snacks. My hope is that these guys do get a bid. They've been working very well. They make money. I would not sell this stock. It's too low here. So there's the weekly chart, guys. This company makes money. They've been around for 100 years. The insiders are scooping it up. Institutional investors own 96% of the joint. But the price has fallen off the chart from a high of 1860 last year to a 52-week low of 978. On Friday, the stock closed at 991, losing 33 cents or 3.22%. Is retail overlooking this opportunity because the company sells potato chips instead of microchips? We're going to find out. And is this the month, is this the week, or will Paul Atkins and the one percenters screw us again? Investor attention is once again fixed on XRP as discussions around potential spot ETF approvals intensify across the crypto market. The renewed excitement has led analysts to revisit their XRP price prediction outlooks, questioning whether Ripple could finally break into new highs this month. Stay tuned. Okay, so here are two scenarios. Tech analyst Dark provided a chart to show that XRP's price has finished the third Elliott wave on the monthly chart and that the fifth wave is underway. The forecast shows that the target in the next cycle is between 585 and 10. The primary support zone, where his analysis shows that the fourth wave bottomed out, is at 222. According to the chart, XRP price correction phase aligns with a 23.6% Fibonacci retracement level near 223. This area coincides with the recent price behavior seen across the daily chart, suggesting that buyers are defending the structure. The 70% Fibonacci zone, corresponding to around 301, forms the first resistance region before the potential advance toward 585 and beyond. Or are we going to get this scenario if they delay our ETFs or short them into oblivion? Market analyst Ali Martinez pointed out that the XRP price is magnetized to the support zone of $1.90 to $2. His chart indicates that repeated tests at this level suggest it is a key level at which buyers re-enter. This trend also indicates a midterm retracement period within the broader consolidation pattern. Currently trading near 232, XRP has maintained stability above this critical support despite previous volatility. The $1.90 to $2 range is where previous corrections found strong buying interest. Maintaining this support could set the stage for renewed momentum once the market returns to normal volume. Now, these are bonus slides for all my subscribers that stick with me until the end of the video. They hit that like button and repost my shit on their social media accounts. You want the truth? You can't handle the truth. There is a distinct chance XRP is going nowhere until Wall Street, the Feds, its regulators, BlackRock, the Bitcoin maxis, and the Trump family crypto business is done protecting and pumping Bitcoin, Ethereum, and Solana. There's a distinct chance that XRP is going nowhere until Ripple announces its IPO and stops selling 1 billion XRP tokens a month to finance Ripple's corporate expenses and acquisitions. Do you like any companies that dilute their stocks to the tune of 1 billion shares per month? I didn't think so. There's a distinct chance XRP goes nowhere until financial companies start using it for its intended purpose, cross-border payments, until banks and fintech companies are transferring trillions in currencies using XRP, soaking up tokens, we could remain stagnant. And if you say we have to wait until they flip the switch, I'll punch you in your neck. The case is over. XRP, Ethereum, and Bitcoin are the only projects on the planet with significant regulatory clarity. And maybe we can include some stablecoins in there due to the Genius Act. And don't say we have to wait for the final ISO deadline to flip any switch. XRP, XLM, Cardano, HBAR, Algo, XDC are all already ISO compliant. There is no reason you can't use RippleNet to transfer funds right now, or is there? Another problem is global liquidity and the U.S. government shutdown, not just because it gives the SEC the perfect excuse to delay our ETFs, but it affects liquidity. And global liquidity is a huge problem. What's ironic about that is XRP unlocks trapped liquidity, and they're not using it. Why? Global liquidity tells us how much capital is flowing into the markets. And generally speaking, the more liquidity or the faster it's rising, the better it is for risk-on assets like crypto. You'll notice Bitcoin and crypto track global M2 year-over-year change perfectly. That's why you didn't get in October. That's what killed your altcoin rally. I'll admit, I'm not a crypto expert, but I do know about liquidity and its effect on risk assets. We may remain stagnant until they open the government up again, and we need to get liquidity rising again. And what's the holdup on the shutdown? Why won't Democrats sign a clean CR? Because they want $25 million for climate resilience in Honduras. They want $13 million for civic engagement in Zimbabwe. They want $4 million for LGBTQ democracy grants in the Balkans. They want $2.9 million for desert locust reduction in Africa, and another $2 million for organizing the feminist democratic principles in Africa. Worst of all, they want to provide somewhere around $200 billion in health benefits to individuals in the U.S. illegally and use federal dollars for their Medicaid coverage. What's most frustrating about that is it was Democrats that voted to fine American citizens for not buying health insurance and then conspired to give it to illegal aliens for free. Now, while I'm working on this video, this popped up. Senate nearing a deal to end government shutdown. Senate Democrats signaled Sunday that they are prepared to move forward with a legislative package aimed at ending the government shutdown. At least 10 Democrats are expected to back a procedural vote to advance a bundle of long-term spending bills along with a short-term funding extension, sources from both parties told Axios. The reported deal also includes a pledge to hold a December vote on extending the Affordable Care Act tax credits. And another thing that can keep XRP's price depressed is 40% of the entire XRP supply is held by one entity, Ripple itself, until the street knows exactly what their plans are for this massive amount of tokens. We may just dribble around. Give us a hint. Are you going to loan some out for central banks to use or the IMF? I know my ears would have perked up at the Ripple Swell event if they were to give us any indication what the long-term plan is, for the Treasury, other than blowing out of 1 billion tokens per month. That would be useful information. And here's another issue. When will the price of XRP decouple from Bitcoin and the rest of crypto? One project, Bitcoin, is supposedly digital gold, and one is used for cross-border payments, and in my opinion, is a competing digital currency to fiat dollars. I don't think Bitcoin is digital gold. It's not backed by gold. You can't spend it cheaply. It has to be mined, and it's very energy inefficient. It's slow. I think it's a box of shit, if you want to know my opinion. So why does my project have to track it or crypto in general? You want to know about another problem? These assholes from Wall Street have officially made their way over to the crypto space. How do I know? HBAR's brand new ETF, HBR, is already on the threshold list. It started trading October 28th, and now, 12 days later, it's on the FTD list. Guys, we are trading in a cesspool of corruption. Dark pools, algorithm abuse, you name it, they're doing it, and it's all unsupervised. I want you to know, FINRA and the SEC, they are not regulators. They are the Fed's liaison to Wall Street. They are not enforcement. Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.